Hundreds of billions vanished in mere hours. Black Monday 1987 was a financial earthquake that struck the global stock markets on October 19, 1987, seeing the Dow Jones Industrial Average plummet by an astonishing 508 points, representing a colossal 22.6% decline in a single trading day, a figure that remains the largest one-day percentage drop in Wall Street history. This unprecedented collapse wiped out approximately $500 billion in market capitalization. The preceding week had seen substantial market volatility, with the Dow dropping over 250 points in the 5 trading days leading up to the crash itself, suggesting a buildup of pressure. A major contributing factor was the then relatively new concept of programmed trading, specifically portfolio insurance strategies, which involved automatic selling of futures contracts as prices fell to protect investor assets. This automated selling created a vicious downward spiral, amplifying the initial declines as more selling triggered further selling in a cascading effect that overwhelmed market liquidity. Specialist firms struggled to match buy orders, with the overwhelming number of sell orders creating a massive imbalance. The market opened that Monday with selling pressure already intense, following a 250-point drop in the previous week alone. Trading volumes soared to over 604 million shares on the New York Stock Exchange, which was nearly double the previous record set just a week earlier on Friday, October 16th. International markets felt the shockwave profoundly. The Hang Seng Index in Hong Kong fell 45.5%, the FTSE 100 in London dropped 26.46%, and the Australian All Ordinaries Index tumbled 41.8% in the following days and weeks as the contagion spread across time zones and trading floors. The swiftness of the crash was breathtaking, leaving market participants bewildered and regulators scrambling to understand the mechanics of the event. To avert a complete financial system meltdown, the Federal Reserve, under Chairman Alan Greenspan, quickly intervened by issuing a statement affirming its readiness to provide liquidity to support the economic and financial system. Banks were encouraged to lend to struggling brokerage firms, and the immediate panic began to subside. In the aftermath, one of the most significant changes was the implementation of circuit breakers, which are automated trading halts designed to temporarily stop market activity during extreme price declines, thereby allowing market participants a moment to reassess and prevent panic selling from spiraling out of control. These new rules were introduced in 1988 to manage excessive volatility. Prior to this event, there was no mechanism to pause trading in such extreme circumstances. The recovery from Black Monday was surprisingly swift, with the market regaining much of its value in the following months, indicating underlying economic strength and a resilient financial system, even in the face of such a severe shock. Over 3 decades later, the lessons from that chaotic day continue to influence financial regulation and risk management, emphasizing the interconnectedness of global markets and the potential for technological systems to both enhance and destabilize financial stability. The volume of trading that day was nearly double the record set just days prior, highlighting the sheer force of the selling wave that engulfed nearly every stock. The market was essentially frozen by the speed of the decline, creating a desperate search for buyers where none could be found for extended periods. $500 billion evaporated in moments. Black Monday, 1987, was an unprecedented financial earthquake shaking global stock markets. October 19, 1987. The Dow Jones Industrial Average plummeted 508 points, a colossal 22.6% decline in one trading day, a record largest one-day percentage drop. This monumental collapse wiped out $500 billion in market capitalization. The preceding week foreshadowed trouble, with the Dow falling over 250 points, leading to a programmed storm. Programmed trading, particularly portfolio insurance strategies, involved automated selling of futures contracts as asset prices fell to safeguard investor wealth. This algorithmic selling mechanism created a vicious downward spiral, amplifying initial declines as more selling triggered subsequent selling, overwhelming market liquidity. Specialist firms struggled, unable to match buy orders with immense sell orders, creating a massive imbalance, a true global freeze in market activity. On that Monday, trading volume on the New York Stock Exchange surged to over 604 million shares, nearly doubling the previous record October 16th. The shockwave reverberated internationally. The Hang Seng Index in Hong Kong plummeting 45.5%, the FTSE 100 in London dropping 26.46%, and the Australian All Ordinaries Index tumbling 41.8%, demonstrated global contagion. The crash's rapidity left market participants bewildered and regulators scrambling. To prevent financial system meltdown, the Federal Reserve, under Chairman Alan Greenspan, intervened, affirming readiness to provide liquidity. Banks were urged to lend to struggling brokerage firms, and panic began to recede, creating a temporary global freeze of confidence. In the aftermath, a profound change was the introduction of circuit breakers in 1988, establishing a crucial legacy automated trading halts designed to temporarily pause market activity during extreme price falls. This innovation allowed market participants time to reassess, preventing uncontrolled panic selling. Before this, no mechanism to halt trading existed. The recovery from Black Monday proved rapid, with the market regaining much of its value in months, showing underlying economic resilience. Over 3 decades later, the lessons of that chaotic day continue to shape financial regulation and risk management, emphasizing global market interconnectedness and technology's dual capacity to both enhance and destabilize financial stability. The market essentially froze from the speed of decline, desperate for buyers who did not exist for extended periods, creating a complete global freeze in trading confidence. $500 billion disappeared instantly, a terrifying financial hole. Black Monday, 1987, ripped through global stock markets on October 19, 1987. The Dow Jones Industrial Average plunged 508 points, a colossal 22.6% drop in a single trading day, setting a new record for the largest one-day percentage decline. This monumental collapse wiped out $500 billion in market capitalization. The preceding week offered grim warnings, with the Dow falling more than 250 points, which set the stage for this programmed storm. Program trading, especially portfolio insurance strategies, played a significant role. These strategies involved automated selling of futures contracts as asset prices fell, a supposed safeguard for investor wealth. This algorithmic selling mechanism unfortunately created a brutal downward spiral, amplifying initial declines as more selling triggered subsequent massive selling, overwhelming market liquidity. Specialist firms found themselves unable to match buy orders with the immense deluge of sell orders, creating a vast imbalance, a true global freeze in market activity. On that fateful Monday, trading volume on the New York Stock Exchange surged to over 604 million shares, nearly doubling the previous record from October 16th. The shockwave of this event was not contained. It reverberated internationally with devastating impact. The Hang Seng Index in Hong Kong plummeted 45.5%, the FTSE 100 in London dropped 26.46%, and the Australian All Ordinaries Index tumbled 41.8%, clearly demonstrating global contagion. The sheer rapidity of the crash left market participants bewildered, and regulators were left scrambling for solutions. To avert a complete financial system meltdown, the Federal Reserve, under Chairman Alan Greenspan, intervened decisively, affirming its readiness to provide necessary liquidity.